Welcome back to Rockstock Channel. It is Tuesday, March 11th, and we are back with an update with Lithium Universe following our first interview with Chairman Iggy Tan last November. Lithium Universe is progressing plans to construct a lithium refinery in Bécancour, Quebec. The company trades on the Australian Stock Exchange, ticker symbol LU7. Current stock price is about 0.009 cents, which is actually up 12.5% year to date, but down 25% from its last equity raise at 1.2 cents around the time of our first interview. Current market cap is about 9 million Australian dollars or 6 million US dollars. I just spent several days in Toronto at PDAC. I'm wearing my Canada Rocks hat, which coincided with a lot of volatility in the Canada and US economic and political dynamic, which we can talk about toward the end of this conversation. But first, Rodney will dig in to all the news flow since our first discussion last November, including Lithium Universe's publication of a definitive feasibility study last month. For more information about Lithium Universe, visit their website, lithiumuniverse.com, or follow them on X at Lithium Universe. You could also follow Iggy on X at TanIggy. As a reminder, Iggy is one of Lithium's OGs, having founded Galaxy Lithium, which built the Mount Cattlin spodumene mine in Western Australia and a carbonate conversion plant in China with Tangxi Lithium. Galaxy merged with Orocobre, which then became Allchem, and then Arcadium, which Rio Tinto finalized its acquisition of last week for $6.7 billion. Iggy has assembled what he calls a dream team of lithium chemical experts to help fill a critically important midstream processing gap in North America. Unlike some of its peers, Lithium Universe will focus on building a lithium carbonate rather than a lithium hydroxide facility and will use conventional technology that China has perfected over the last 2 decades. For disclosure purposes, Rodney and I are both advisors to and invested in Lithium Universe. We are not, of course, financial advisors, and nothing in this video should be construed as financial advice. Please do your own research and read the disclaimer at the end of this video. Note that a written summary of this interview will be published in the next edition of RK Equity's Lithium Ion Bull. Please register your email at rkequity.com if you'd like to receive this newsletter directly to your email box. And with that intro out of the way, welcome back, Iggy, to Rockstock Channel.
Hi, Howard and Rodney. Thanks for having me back.
Great. Iggy, to recap for the viewers, the Lithium Universe thesis is you're looking to build a merchant or potentially a JV'd converter in Bécancour in Quebec and utilize the lithium carbonate flow sheet and equipment, plus your core management team that was successful and successfully implemented at Galaxy to produce battery-grade carbonate outside of China. Is that a fair summary?
Yes, Rodney. We are trying to fill the conversion gap in the North American region. A lot of mines are being developed and a lot of battery plants are being developed, and there's a big gap. So there's not a lot of conversion technology being developed. And the ones that have been developed around the world, you've seen some failures. And so what we had the idea was, why don't we replicate what we did in China about 15 years ago when we built the Jiangsu lithium carbonate plant. Maybe we were lucky, but that is actually operating well above design and basically producing some of the best battery-grade lithium carbonate in the world today.
That's great, and I think it's important, and Howard mentioned, that others, especially in Australia, have had a crack at hydroxide, which has proved to be challenging. So, your focus is carbonate, and that's the one you did in the past. So you've recently completed a DFS, and the board has made a final investment decision. What are the next steps towards funding and taking the project forward?
Yeah, thank you, Rodney. So in October last year, we finished a pre-feasibility study, and recently we completed the DFS. Now, considering we only been listed about 18 to 20 months on the boards, completing a full DFS on a lithium carbonate plant is a mean feat in that time frame and in the money that we use. So the reason we're able to do that, as I said, we're not trying to reinvent the wheel by coming out with a new design. We're essentially taking the technology we built in Jiangsu and replicating it. So same flow sheet, same suppliers, and same equipment. So that's our vision, and just to manage the risk. So our DFS very successful. The capital cost is about $549 million US. It generates an EBITDA of 148 million US per annum, and we use a very low lithium carbonate and spodumene prices for the model, around 1,100 for SE6 and under 21,000 for the lithium carbonate. And the NPV for the project, very strong. It's 718 million US. And the idea was that we wanted to stress the project out with very low numbers to see how the project stands up. And the good news is it stands up well because essentially we've got some benefits in that we have very cheap power in Quebec. That's number one. If you look at comparing that power all around the world, even in China, the power from Quebec is world class. The other benefit is that we're close to the mines in Canada, where there's no long transport costs all the way to China and back. And then thirdly, there are also some tariffs that Canada's put in place, 25% tariffs on Chinese lithium chemicals. So if you're taking all that into account, we're actually very competitive with the Chinese conversion plants that are built in China today.
And I guess another thing, just looking at the metrics of the study, is that it would be greatly improved if there was potential to get some low cost or even grants available in the region. Is there some potential government assistance that you could access?
Absolutely. There's quite a lot of grants and tax incentives in Canada. I think the critical minerals funds. But what we try to do is not incorporate any of those grants or even tax incentives, just to see how the financial model stacks up. And without all those grants and tax benefits, the financial model stacks up really well. So anything beyond this point is really a bonus from the project level.
And Iggy, one of the things that's always a challenge for new projects is permitting, but given the nature of your model, you are going to be, in a downstream from mining, and it's in Bécancour, which is a well-established industrial hub. But just to clarify, what would be the final steps, if any, for permitting approval to actually construct a plant there?
Yeah, we've conducted some initial environmental surveys, and basically there's no environmental showstoppers. The land itself was previously farmland, and we're in the industrial park of Bécancour. Namaska 2 is down the road, Echo Pro. So we have all the utilities, natural gas, cheap power, railway, highways, and the most important thing, it's 2.5 k's away. We have the Bécancour port, where we can actually ship spodumene in down the St. Lawrence River to the site. So we're just not limited to spodumene from within Canada. We can access spodumene from Africa or Brazil, and that's why we see Quebec as the processing center for spodumene for the North Atlantic region.
And Iggy, how long would it take to construct a plant?
Well, generally we are saying that this year will be in the financing phase. If we can get some equity partners in, we can start ordering long lead items. Generally, the construction is 2 years, and so we're looking to have our first product out by 2028. So we're very focused now on the next phase, which is financing, and obviously offtake. So we are looking for partners that have spodumene today, or will have spodumene down the track, that needs to be converted. So, as you know, Canada is putting a lot of pressure on some of these producers to not ship that spodumene to China.
Right. And the objective then is to find a 49%, so you stay in control of 49% partner?
Yep, it's not necessarily one partner at 49%. We are looking at several partners, most probably an OEM that either has spodumene offtake, an OEM that actually wants lithium carbonate as an offtake supplier, and we're also looking at various other groups that might be interested in being a shareholder at the project level.
Right. And in terms of what we've seen happen in Australia and two major projects faltering, are you noticing an increased sense of urgency for conversion capacity ex-China, and particularly in the region? Is that something that people have picked up on and are conscious of?
Yes, and I don't know whether you've heard that recently China announced the ban on technology, chemical processing technology being exported from China. Now, we don't really know what that ban looks like, but we're in a fortunate situation where we have that technology outside China, and obviously we're trying to put that into Canada. Now, a lot of people understand that the hard rock processing technology is Chinese technology, but essentially it was an Australian company called Galaxy Resources that built and put in that processing technology in China all those years ago. When we built that plant in China, it was rated at 17,000 tons per annum. The whole market in China was only 30,000 tons, and the largest plant that was operating at the time was Tianxi's Shihong plant, which is only 4,000 tons per annum. So essentially, Jiangsu became the benchmark for most of the Chinese operations and now exported worldwide. So, the technology is with an Australian company, and all we've done is now taken that technology with Hatch, and we're trying to replicate that in other parts of the world, like Quebec.
Right. And just back to the study, inflation is something that mining and processing industry hasn't been able to escape, I guess, in terms of all of the inputs. It's always prevalent, but you have some fixed price packages for equipment in the study. Can you just elaborate on that and how that is beneficial?
Yeah, the reason we can get a study that's very accurate in capital costs, we believe, is that we essentially went back to a lot of our suppliers that build the first plant. And, I'll give you an example. We went back to the kiln supplier, which is a Chinese company, and we said, we want exactly the same kiln you built for us, 15 years ago. And they had the construction drawings. So most of our suppliers just went back to the old files, and that allowed us to get very firm quotations for the project. So because they've already built this before, that really takes the risk out of these capital projects.
Right. And in your economic model in the study, you've got a steady state recovery of 88% and 86% if you include annual shutdowns. That looks fair and conservative. We see those kind of recoveries on some of the older plants, but yours is a new plant. Is there some scope possibly to produce slightly better results than that?
Yeah, well, the difference with our study is that we're using very realistic numbers. You see a lot of projects that come out with a 90% recovery or 90% utilization. Our philosophy is use some real numbers that most of these plants operate at, and then if they operate better, then that's a bonus. So coming out with a recovery of 90%, we think that's just not sensible. Most of these plants run around 88%, 87% recoveries.
Right. And if you look at the DFS economic model in terms of the split in margins, there's an expectation of a shift from the feedstock supplier to the converter. Is the low price of spodumene concentrate, which is currently closer to break even, the underlying driver of the existing split? So I guess what I'm asking is, will the margin split, is it likely to naturally shift as spodumene concentrate prices rise to well above break even, or is something else likely to trigger a change?
Well, generally, I think I mentioned before, the margins on the concentrator versus margins on converters are generally, they may flex around, but Tianqi was a good example where they own both assets, and when they reported it on their annual reports, when the margins were 64% on the mining, it was 60% on the conversion. So it sort of makes sense, because you still have to repay the capital for both of the projects. So we believe that the margins are in the converters as well. They may flex around at different points in time, but that's why we think it's a good business. We're essentially a chemical company, and there are very successful chemical companies all around the world just doing what we're doing, just buying feedstock and converting into chemicals and selling that chemicals to the market.
And Iggy, you've tested a range of spodumene concentrate feedstock through your testing?
Yeah, absolutely. We purposely bought some of the high impurity material with just to simulate our process to make sure that we can handle most spodumene around the world. And we're happy to say that all the material that we tested produces battery-grade lithium carbonate without any problems. The other area on the study that's most important is the aluminosilicate byproduct and the sodium sulfate. So in the carbonate process, you've got two byproducts, sodium silicate as one byproduct and sodium sulfate. You need to find a market for those, because it becomes a high cost if you have to dispose it. We luckily have signed an MOU with Lafarge, part of the Holcim Group, which are one of the largest cement producers in Canada. And they will be taking our aluminosilicate as a byproduct to use in the cement production. So we have demonstrated that in China, that people use this material in cement production, which reduces the CO2 footprint, reduces the cost of cement. And so we're very proud of getting that underway. And we're also looking to sell that sodium sulfate to Africa. So sodium sulfate is used in the textile industry as well as the detergent industry. So virtually all the byproducts of our process have already been allocated for.
Yeah, that's helpful. So with respect to timing, Iggy, it's a fool's errand trying to project this market, but we feel like 2028, that we're likely to see a balanced and improved market. And looking at your timelines and a ramp-up period would mean, you need to start building quite soon. So you've mentioned your funding and your construction. The target then is to land up and be kicking off the project around that timeline?
Yeah, I guess we have a more positive view of the recovery. Having been through this cycle 3 or 4 times, I can guarantee you that the price will recover, and has always recovered. All right, and we have, we hear commenters saying that you'll never get to the boom that we had, a few years ago. Well, we disagree with that. Essentially, along the same lines that I said before, we've got a double whammy coming. Supply has come off 20% year on year. That's a big issue for supply in an industry. The other important thing, because of the low pricing, a lot of the development has stopped. Basically, people have stopped exploring, people have stopped doing their studies, and this will have impact 7 to 10 years down the track. So supply coming off, which is 20% down, the slowdown of this development will impact us. Now, the double whammy is that the growth hasn't changed. The growth is still strong. EVs are growing at 29% year on year, and everybody's talking about the slowdown in EVs in the US and Europe. As you guys know, it's not about US and Europe, it's all about China. That's how the lithium went last time. It's all about the demand coming from China. BYD just shipped out 3 million vehicles last year. So that's the underlying demand. That hasn't changed. Our view is that commentators don't look at other areas of demand, electric buses. Nobody talks about how many electric buses are coming on stream in China. And nobody talks about all the grid storages coming on, grid storage batteries that have to come on to support these solar farms that are being built. So expect it to grow, 14 times than the EV. So when you have this thing happening, our view is that when the price recovers, it'll take off. It'll take off as quick as last time. And that's the reason why we're doing all the work in this pricing environment. It's a hard slog when you're trying to raise money at these prices. But we believe that if you do the work, and when the market changes, you are first out of the block. So that's our strategy. And I think you'll be surprised when it actually does take off, how quick it does take off.
Iggy, that sounds like a fantastic, optimistic thought, which was the title of our last Lithium Bull. And we've been focused trying to get a handle on, the AI data center feeding the ESS, battery ESS story. I do note that BYD announced what looks to be a $5 billion follow-on offering. CATL reportedly is raising $5 billion through an initial Hong Kong listing. So you're right. Few people are paying attention. We are. You're in Australia, and you're very plugged into what's happening in China. But what people have been paying attention to lately, every day, are the two most high-profile individuals on the planet. Donald Trump and Elon Musk, and a lot of volatility, in Tesla stock price and global markets, largely as a result of uncertainty injected into the Canada-U.S. political relationship or economic relationship. So I'm trying to parse through the tea leaves here. What we saw Critical Elements and Frontier at PDAC, and they recently made some announcements which seemed to be catalyzed in terms of prospective funding, bank lending, and or government funding. But they even referenced, one of the companies referenced Trump tariffs, in their quote in the press release. So what does this mean? How are you reading those tea leaves for Lithium Universe?
Yeah, so I guess we get the question all the time, how does, the tariff wars with the US impact on Canada? Our belief is that Canada is now much stronger on onshoring the supply chain. As you As you know, Canada produces 1.5 million vehicles every year. They're moving towards the EV industry. They need their supply chain. So nothing's changed for us. I think they're going to be much stronger. There will be more government support on the onshoring side. And then, I come back to the last bull run. Name me one analyst that predicted that bull run where the lithium price increased 360% in 6 months. In 6 months, it went up to $80,000 a ton. No analyst predicted that because it's not about just the supply and demand curves. They're also buying behavior. There's speculation. So as you know, if everybody believes that the price of the lithium is going to go up because it's unsustainable, and as soon as it moves, if you're a battery producer, you've got a lot of contracts of batteries at that low price. As soon as the price goes up, you start to buy that and to fill your inventory. What do? Is you then create demand that's above the natural demand, and that forces the price up. So everybody then jumps on, and then that's where you get a 360% increase in lithium price in 6 months. It doesn't make sense. It doesn't reflect demand or supply in those 6 months. So there are a lot of factors that can impact on this, and I hear analysts saying it'll never happen again. Well, it's happened about 2 or 3 times before this. So what's going to be different? This time, the demand is just through the roof.
Yeah. I've been comparing 5 years ago, COVID kind of hit and I came back from PDAC and then all of a sudden we were in lockdown. The stock market crashed, in March of 2020. But I'm making some comparisons to the supply chain disruption caused by this uncertainty with the Trump tariffs and just the general uncertainty in March. 6 months later, it was Tesla's battery day, in September of 2020. And that rise that you talked about, started, around that time. So we have, I think there's a lot of legislation passing through the U.S. It's going to take a number of months, but hopefully a fair bit of this uncertainty, by September will become more clear. There's the prospect of some sort of grand bargain we're hoping for with China. I want to reference, I did hear Ken Brinsden of Patriot Battery Metals give a presentation at the benchmark event, at PDAC, and he was articulating a lot of the positive view that you're talking about, on battery energy storage. I was also with a company, a brine story that attracted an investor from the Middle East, from Israel. And I listened to, Ken Hoffman of McKinsey give a presentation at Bloomberg. He went to the Riyadh, Future Investment Forum in Saudi Arabia in January. And he said everyone was like super optimistic, right? Like the Middle Eastern, money, that they see the vision, they see all the demand that you're talking about. And then they come here, to North America and maybe Australia, and it's all negative. So Ken was quite bullish, on demand, as was Ernie Ortiz from Lithium Royalty Corp. But one thing I forgot about was that Patriot attracted VW, a $50 million investment into the company with some, a small bit of offtake, and long-term, negotiations to discuss. So you were talking about some OEMs. I was just thinking, like, you have a great business plan, but you don't have spodumene and you don't have, yet the deep pockets of a strategic. But like, could there be some MOUs with the likes of a Volkswagen, the likes of a Patriot or a Winsome, or some of these other spodumene developers that right now don't, or Sayona, they're forced to sell to China. But looking down the road, could these be, some, without getting into details of specifics, but what are your thoughts? Echo Pro is another one. Like, who's active in the region who actually, especially if you look at Canada specifically and you're not looking at Canada to the U.S., could that dynamic, catalyze, quicker, integration or deals.
Yeah, absolutely, Howard. We have been waiting for the DFS to be finished, and now we're having those conversations, serious conversations with all those players, including Brazil, because it just makes sense. They just need the material converted in this side of the world for this market. It's not rocket science, but unfortunately, not many people are building converters. So we're in a nice situation. We're having these conversations, and our next milestone will be to secure an OEM that has the spodumene feedstock for the plant. And then the next step is to secure the OEM that wants the final lithium carbonate. So we're ticking boxes as we move. We know how to do this. We've done this before. It's there is a formula. You're just working through it, and we're working through it while the market's poor. We don't care about that. We just want that when the market recovers, we're in a prime spot. We've already well underway with funding, offtake, and that's really when you really get notice when this recovery happens.
That's great. Well, you've moved with China speed from PFS to DFS. I think we interviewed you in November, and you just had the PFS, and here you are, February with the DFS. So that's great, and appreciate. You've done this before. You've seen this market's ups and downs before. We're 2.5 years or 2.5 years into this down cycle, and typically the cycles are about this long or a little bit longer. So I hope you're right. SQM articulated maybe 2026 should be better. They're the cause of this problem as much as anybody else, in my opinion, with their low cost carbonate and ramping up that activity. But anyway, I gotta go, Iggy. It's really good to see you again, and look forward to following all the news flow and developments throughout this year, and we'll have you back in a couple of months.
Thanks for having me. Thanks.